Good afternoon, everyone, and welcome to another one of our live webcasts. My name is Mitchell Sneddon, and I'm the Head of Portfolio Services here at InvestSMART. And this afternoon, we're going to be taking a look at managed fund versus separately managed accounts. Now, a couple of years ago, separately managed accounts are probably not a term that you would have been overly familiar with. However, they have started to make quite a not a comeback, but they've come onto the scene quite predominantly in the last few years, and not just ourselves, InvestSMART offer separately managed accounts, but a number of other platforms do as well that you might have seen. So what we're going to do today is take a look at the ins and outs of a managed fund versus separately managed account. Are there what are the differences? Also, is one better than the other at all? So but first, as we do jump into this, the first slide that I put up out of all my presentations is always the most important one. That's our disclaimer. This is general advice only, of course. I don't know your personal circumstances, and that's probably more relevant when we do get into the actual questions that you can send through. So please take into consideration that I don't know your personal circumstances, so this is strictly general advice only. Now, speaking of questions, as we go through the main part of the presentation today, you'll be able to submit questions just below the little video screen on your computer there, and you just need to put in your name and then type in your question. So as you do that, I'll get through the main portion of the presentation, and then I'll come to those questions at the end and answer all of them if I can and if time's permitting. So please send them through. Make sure you pop your name up the top, and I'll get to those at the end. Now, so the agenda today, we're going to go through how managed funds and separately managed accounts both work, the pros and cons of both of them, and what you need to know as well when you're looking at them separately. Then as well at the end, we'll combine them the two together and see the differences between them in some key areas. So, on to managed funds and how they work. So managed funds are open-ended unit trusts. When we say open-ended, that means that capital or money can flow in and funds can flow out. That's through the process of applying for a fund and then redeeming your cash from the fund. So that's what we mean in open-ended. An example of a closed-ended fund would be, say, a listed investment company or a listed investment trust, which you might have seen a few of those recently. And that means they raise the money once, and so applications go in once, and then it's locked in, and so the funds don't get returned to unit holders or to shareholders when they choose to leave that investment. You have to sell your shares to someone else. So that's the example of a closed-ended fund. So open-ended, they can come in and come out when and how they like. Now, managed funds can be listed. You will see a lot of some at the moment managers listing their managed funds, not in the form of a listed investment trust, but actually in the form of an exchange-quoted managed fund. There's another term, M funds, out there that the ASX have, and so they're becoming more and more common as well. It's just another way to transact. So another way to get your cash into the fund is to have it listed, and so you just go through your broker, just like you're buying a stock. Now, typically, the managed funds will be unit priced daily, so their value will be calculated on a daily basis. And so that means you can enter it on a daily basis and exit on a daily basis. With some managed funds, though, will have, say, a weekly unit price schedule, or some even rarely, but some do have a monthly unit price schedule. And that will be in the product disclosure statement for the particular managed fund that you're looking at. Now, with a managed fund, you will generally speaking not know all of the stocks that are in that particular portfolio. What you will receive is generally a monthly or quarterly update from the manager, letting you know the top 5 or top 10 positions, and then a bit of commentary around how they see the market or some of their core positions. So you're not going to get that full level of transparency that you would get, of course, if you're managing your own portfolio. So that's just something to be aware of when it comes to managed funds. Now, the pros and cons for investing in a managed fund, and the first one here is for any managed product, you get instant diversification. Even if it's a concentrated portfolio that only holds 10 or 12 positions, you're still getting instant diversification with your investment as soon as you go into that. So instead of, say, putting the minimum of, for example, a $25,000 minimum into one stock, you could put a $25,000 minimum investment into one fund and you instantly get 10, 12, 20, 30, 40, 50 stocks instead of just that one. The other benefit, of course, and some people might see this as a negative, but you get the benefit of a professional manager, so someone else making those decisions for you so you can get on with your life. There's a large variety of different investment schemes and strategies out there. And another pro is they always trade at the actual value of the net tangible assets of the fund. So the actual value of the fund and the value of the shares that are in it, that is what the managed fund will trade at. Less, of course, the buy-sell spread. Now, a buy-sell spread is going to vary by 0.5% either side of the net asset value. So, for example, the sell side, when you're redeeming units, it'll be 0.5% less the value of the net tangible assets of the fund. The buy side will be 0.5% more of the value of the net tangible assets of the fund. Now, what the buy-sell spread does is it gets absorbed by the fund into all those day-to-day running costs, like settlement fees and transaction costs that the fund incurs from transferring cash in, your applications in and redemptions out, and also brokerage costs and things like that for buying stock in the fund. So it's there to cover off those small little day-to-day charges that the fund incurs through its natural life. And of course, a managed fund will give you relative simplicity as well when it comes to tax reporting. It's just a couple of pages stating the distribution and whatnot, and it's quite simple when it comes to that side of things. Now, the cons: it is a pooled investment, so you do not own the actual underlying stocks, you own the shares. The open-ended structure allows money to flow in and to flow out. Now, that can cause a fund manager issues, say especially when there's a run on redemptions. So for example, if a fund manager is only carrying 10% cash but something adverse happens and clients want to withdraw 20-30% of the funds, then the fund manager is going to be a forced seller right to create liquidity for that fund right at the time when they really don't want to. So that's something to just keep in mind of with an open-ended structure. That's something that a closed-ended structure doesn't suffer from. Now, you cannot transfer stocks in or out. For a fund, it's just cash in, cash out. That is it. So just keep that in mind. And this last top point, it says it's not overly tax efficient. There are rules coming into place or have come into place to look to change that. What we say by this is, for example, if there was a large investor and they were to pull out of the fund, then any capital gains tax would actually their investment incurred would actually be spread across all of the other unit holders. So if I wasn't there at the end of June 30 and got a tax statement, then I wouldn't be paying historically any tax on the gains that I received as a part of being a unit holder there. I'd pay tax, of course, on the capital gains that I received just from the unit price movement, but not from the underlying stocks that I would have held as part of the fund. So what to consider when looking to invest in a managed fund? The first thing that I look for, and what most investors look for, are fees. Now, I'm not anti-fees at all, and I'm not even anti-performance fees. I think everyone should get paid fairly for doing a fair job. But when it does come to performance fees, I want to see the terms high watermark in place. A high watermark means that, say for example, if your fund does 10% one year and you charge a performance fee or get charged a performance fee, the next year it goes back to zero, it has negative performance. Then the following year it goes up again and gets you back to that 10%. If you did not have a high watermark in place, you'd be getting charged a fee on getting you back to where you originally were before. Okay, with a high watermark in place, what happens is that they get you back to that 10%, and then if you get above that 10%, then a performance fee may occur. So you have to get back to the highest point that you're at previously and then perform. So that's something to keep in mind. I think it's only fair that most managers have that in their structure. I know for our small cap portfolio, it's definitely there. Now, also, do you understand the investment strategy? This sounds like a pretty simple one, but you want to know how the fund is generating its gains, and so that way you can also understand how and when it has its losses, why it has those losses, because every fund manager inevitably will. It's a very challenging game, and every single fund will have its ups and downs, but you've got to be just as comfortable in those ups as you are in the down period. So you need to understand the actual investment strategy. If you don't know how it works, if you don't know what derivatives are, for example, then don't invest in a fund that uses them. Okay, that's just a pretty straightforward one there. But just be aware of your income requirements as well, because a managed fund typically will distribute its income twice a year. So at the end of financial year and at the end of the calendar year, you'll get two distributions, typically speaking, from a managed fund structure. And just be comfortable with the level of visibility that you have of that portfolio. A lot of small cap funds, for example, will only show you the top 5 holdings. They might be holding 30 odd positions, but they will only show you the top 5. And that's because a lot of the stocks in the portfolio might be illiquid. So you just need to be comfortable with that level of visibility. Now, a separately managed account, and we'll tie all this together in a very short period of time. It's once again just like a managed fund. It is managed by a professional fund manager. Okay, you actually though own the shares. So picture a separately managed account like your own managed fund, and you're the only sole investor in that managed fund. And say if the fund manager's got 100 clients across one separately managed account, there'd be 100 different individual accounts set up for them, and they'd all own their little parcel of shares, and it's all done on a percentage basis. So for example, if you had someone come in, if as a manager you had someone come in and they had $10,000, and then you had someone come in and invest in the same portfolio with $10 million, they'd get the same stocks, and it'd all be allocated on a percentage basis. So as a fund manager, I might have BHP in my portfolio at 5%, so the $10,000 person gets 5% of BHP, but so does the $10 million person. So it's all done on a percentage basis, and that manager, when they're wanting to sell or buy a stock, they're just changing the weighting in their model portfolio, and that changes things across the board in the separately managed account. So if, for example, again, if BHP was 5% of my model portfolio as a manager, I wanted to sell down BHP, I might change that from 5 to 3.5% to take some profit. That will trigger a sell action across my portfolios, and everyone's portfolios will be brought into line at 3.5% with BHP. Okay? So that's really important, and it's important to know that you own shares as well and not units. So that comes into when we're talking about the pros and cons here on this next slide. So we've got 100% transparency. You can see all the trades, and so all the buyers and all the sells. With a managed fund, of course, you don't get to see that, but with a separately managed account, you literally will see every single stock. So if I've got $10,000 in this model portfolio and someone's got $10 million in it, we get to actually see our exact stocks. It's no hiding, and that means we're not hiding any winners, you're not hiding any losers. So, I mean, that can be an important thing for some people, or some people just don't even care, because at the end of the day, with a separately managed account, you can't change that model portfolio, as in you can't say, no, I don't want that much BHP, I want this much. You can't do that, just like you can't do it in a managed fund. And your value in the managed fund just bobs up and down with the unit price. Consider your total balance in a separately managed account very similar to a unit price total dollar value, because at the end of the day you can't change it. Yes, you do have more transparency around it, but you still just have to be as comfortable with the manager and their approach as you are with a managed fund. So just keep that in mind. And now, one of the other bigger benefits of the separately managed account structure is the ability to take income as and when you like it. So there's a few different ways. You can, of course, not take any income at all. What happens to the income? It goes back into the portfolio, into the cash component. When that cash component, when the manager decides to buy more stock, it'll come out of that. Or when that cash component exceeds the weighting, the allocated weighting in that model portfolio, it'll trigger buy orders across the underweight stocks. Now, the types of income that you can receive with ourselves and our separately managed accounts, you can actually receive dividends as and when they're paid by the company. They get swept out to you into a bank account of your choosing. You can have a monthly drawdown plan. So if you wanted $1,000 a month or $2,000 a month, you could have that set up. You can then also do ad hoc payments as well. So for example, you need $10,000 right now, or you need $5,000. It's completely up to you, and you just send in the request for that, and that will be actioned for you. Now, additionally, you can have a combination of all three of those in play if you wanted. So there's a lot of flexibility with the separately managed accounts as opposed to a managed fund. So that's just something that investors should be wary of. If you do not have any income needs, then it won't make any difference whatsoever for you. But if you do, then you certainly take it into consideration. Now, as I mentioned, one of the cons, you cannot exclude any stocks from your portfolio. If it's in the model, it's in the model. This is not an individually managed account where you actually can have some form of say. This is a portfolio that runs to a model, and everyone's portfolio who's invested in that model is running to the same percentage same percentages in that model. Just like a managed fund, you cannot have your say in what stocks go in there. You either agree with the manager and their philosophy, or you don't. That is it. Now, there's less paperwork as well with a separately managed account than it is, say, owning your own share portfolio. However, it's still a little bit more though than if you had just a standard managed fund, because you do actually own the underlying components in the separately managed account. So that's just something to keep in mind as well. Now, what to consider when looking to invest in a separately managed account? First of all, does your separately managed account, does the platform allow you to have multiple models in the one? I know for a fact that ours does. You can say not just have the growth model, but you can also have a bit of the intelligent investor equity income and say the international model, all tied into the one separately managed account structure. Are you paying platform fees as well? So for example, a lot of separately managed accounts will be run on a platform level where you can then choose what managers you would like. With ourselves, we are technically the platform, so we don't charge any platform fees, and you just charge you just have the management fee of the individual portfolio that you've selected. Okay, so just keep that in mind when looking around. As I said, with the managed funds, there can be performance fees associated with separately managed accounts as well. And then keep in mind as well, this is not on this, but you can actually transfer in stock into a separately managed account to start it off. So if you've, for example, been following the Intelligent Investor stock recommendations for quite some time, you might have a portfolio that looks 80 or 60% similar to the one that you're going into. So you might not want to sell all your stock. You might want to transfer that in and then sell the ones that are either underweight or overweight or not in the model at all. That'll get done by the actual administrator. So you don't have to, and that's great. That's a benefit of the separately managed account structure, where you can take advantage of the tax efficiency that it brings. So that's something just to keep in mind as well. So let's get on to the differences, and this is my last slide before we get into the questions. But the differences with a managed fund and a separately managed account, the transparency levels. With a managed fund, you only generally going to see the top 10 holdings or the top 5 holdings, or sometimes not at all. So you just need to be comfortable with that level of transparency. With a separately managed account, you will literally see every single stock you hold because you own it. That's a good thing, and it can also be a bad thing because a lot of people tend to fixate on the stocks that aren't doing well. In a managed fund, you don't know about those positions, but they are there. So that's just something, once again, to keep in mind. Tax effectiveness, the managed fund is just a standard. However, the separately managed account, it's as tax effective as if you yourself are just running your own portfolio. You have no other tax consequences from anyone else that have potentially been invested in that. It's just yourself. And that also comes into consideration when transferring in stock as well. Blending portfolios, what I mean by this is being able to blend multiple models into the one separately managed account. So with ourselves, for example, you can have the international model, you can have the growth model as well, and maybe the property model, and we can blend those together for you just to form one whole portfolio. Whereas with a managed fund, of course, you'd have your one managed fund, you'd go out, have to buy into a completely separate, different managed fund. Not that it's overly tricky, but that's just what you'd have to do. They wouldn't all be under the one roof. Portability of the holdings, what that means is, can you transfer stock in and out, or transfer what you own in and out to other brokers and other platforms, etc. With a managed fund, no, you can't transfer your portion of that fund out to anyone. With a separately managed account, as I said, you can transfer stock in, but then you can also choose to leave and transfer stock out to CommSec or E-Trade or whichever broker you do want to go to. Income, we've been over this. With managed funds, it depends on the individual managed fund, but typically quarterly, semi-annually, or annually, depending on the actual individual fund. With a separately managed account, it's as and when you want it. So that's a benefit if income is a consideration for you. Transactional. Now, this is an interesting one. With a managed fund, the transactional component, what I'm talking about here is how efficient they are when it comes to being able to buy and sell stock for you within that fund. They'll use brokers typically, and they'll be able to work an order. So if it's in a liquid position, a managed fund can take their time and just chip away and buy it over a long period of time. With a separately managed account, they use what is called, what we use the term VWAP, which is a volume weighted average price for that specific day. So if we went out there and bought 5% of BHP, we'd get the volume weighted average price for the day of BHP. So in layman's terms, just the average price that BHP most traded at that day. So we can't work a position. So what that means is a separately managed account isn't suitable for small cap stocks. And so that's why you'll see the majority of separately managed accounts out there generally sticking to the larger, more liquid stocks because of how the transactional side of things work. Now, we can keep the brokerage costs down incredibly low because we're not working orders, but that does mean we are forced up higher in the stocks that we're investing in due to liquidity. Now, that's not an issue as long as you're aware of it. A managed fund, and where a managed fund has the benefits from, and this is why we specifically started our small cap fund as a managed fund, it allows us to invest in illiquid stocks where you need to be a bit more delicate with your buying and your selling of the parcels. So it could take us months to fill an order in an illiquid stock if we really want to be investing in it. That we just don't have that capacity in a separately managed account. So that's something to take into consideration. And with the ownership structure, of course, a managed fund, you own units. In a separately managed fund, you own direct shares. So I'm not trying to say that one structure is better than another here, but something might just suit you as an investor more so than the other. And it might help you understand why some things start out as managed funds and aren't available in a separately managed account, and some are separately managed accounts and they don't choose to go down the managed fund path. So for example, our exchange traded fund portfolios, all separately managed accounts. We don't have any issues there with liquidity and volume. Our Intelligent Investor Equity Growth and Equity Income portfolio, predominantly investing in the larger stocks on the market with our value investing philosophy. So we typically don't tend to have any volume or liquidity issues there. Our small cap fund, though, most definitely needed to be a managed fund. So I hope that clears things up for you a little bit there. I'm going to jump in now and just check out your questions, and if I haven't answered anything right now, please send it through to me and I'll get onto that for you. So just give me one little second. Going to jump across. Okay, we've had a couple of questions come through here, and Peter originally had a question around tax and whether or not it was better to invest in an SMA, a separately managed account, or a managed fund when it came to business or a personal name. Now, that's something that I specifically can't answer, Peter. I think the best thing for you to do if you have concerns around this would be to go and see your accountant, because they'd be able to tell you specifically what the implications of investing in your personal name or your business name. I can answer your other question that you've got here, though. You say, am I correct in understanding that calculating the amount of CGT owed is more complex for managed funds than separately managed accounts? That is absolutely correct. With a separately managed account, it is just purely like you run your own portfolio. So it's very straight up and down, very easy. With a managed fund, we have to, there's a new structure in place called AMIT, where it allows you to spread it's quite a difficult explanation here, to spread the capital gains across the unit holders as a portion of what they actually earned when they were a unit holder. So that's a very bad explanation for that, but there's a new structure where a new accounting style which allows you to do that. So managed funds, if they do choose to take that up, will get better at that, will get more efficient with their capital gains tax. But purely the most efficient structure right now, as far as that goes, is the separately managed account. So yes, you're right, a managed fund is a lot more complex than a separately managed account when it comes to capital gains tax. Let me see here. Brett says, I'm curious as to whether your small companies fund is listed or unlisted. How do we track performance? Should we apply for units? So how do you track performance if you should apply for units? If you do apply for units, one of the best ways, and this is what we do for all of our unit holders, is we actually put it into their InvestSMART portfolio manager. So you can actually see on a daily basis the unit price movement. You can also track it on our website under the Invest With Us section. You'll see the Small Companies Fund tab down the bottom there that you can select, and you can see the unit price. We're also uploading our data to Morningstar as well. So there's three sources where you can see the Small Companies Fund. It is an unlisted fund at the moment, Brett. We have had no discussions internally whatsoever about listing the Small Companies Fund. It is just a pure, straight up unlisted managed fund. To apply for units, the easiest way to do that is just to go to the Invest With Us page on investsmart.com.au. Down the bottom, I believe, you'll find the Small Companies Fund and on all the relevant information there. So you can see the history of the unit price as well as the performance. I hope that answers your question. Brett has another one. Would you also mind explaining the buy-sell spread? Of course. So a buy-sell spread is the difference between a managed fund. The actual underlying value of a managed fund is called the net asset value. So that's calculated on a per share basis. So, when you're per unit basis, I should say. So when you're looking at a managed fund, you'll typically see it might be $1.19 or $1.22 or something like that per unit of net asset value. And then when you go to buy into it, if it's at $1.22, it might be up, $1.22.5 or $1.23. for the buy price, and then you look at it again, and the sell price is like maybe a cent below. It might be $1.21. Now the reason for that is the buy-sell spread is always, the buy price is always 0.5% higher than the net asset value. The spread, the sell price of the spread is always 0.5% lower than the net asset value. So you've got a percent there in total. The reason for that is because the fund absorbs that cost. That 1%. And the reason for that is for any transactional and brokerage costs, etc., that the fund absorbs. So, for example, when you're putting money into a managed fund, there are actually settlement fees that managed fund is paying on the cash transferred on a daily or weekly basis into the actual fund. So that 1% there that people pay when they 0.5% when they go in and 0.5% when they come out. That is to cover off all those transactional costs and the brokerage costs typically. So it's all absorbed. Those costs are naturally absorbed by the fund, and the buy-sell spread goes to covering off some of those costs. Now you can actually see in the product disclosure statement for our small companies fund all the things that the buy-sell spread exactly goes towards. As well. So do download a copy of the product disclosure statement. But that's the most general thing that the buy-sell spread covers. Now, I hope, Brett, I have answered that one sufficiently for you. Stephanie asks, John Mill published a quarterly report not too long ago. Should this be anticipated on an ongoing basis? Absolutely. So what we are intending to do with the Small Companies Fund is to publish detailed quarterly reports. The one that John Mills published had the top 5 shareholdings, a bit of commentary about the portfolio and the recent performance, and a couple of takeover bids that we had in the portfolio as well for stocks that we owned. And then it had a detailed summary of the of one of the core positions in that Small Companies Fund. CSG, I believe it was, off the top of my head. So you can expect this going on a quarterly basis. Will it be specifically John Mills? He is one of the portfolio managers, but there's also Alex Hughes there, and Gaurav Sodhi as well sits on the investment committee for the Small Companies Fund, as does James Carlisle. So I'd expect, though, typically on a day-to-day basis, it's John Mills and Alex Hughes that look after that portfolio. I'd expect to see their names on these reports going forward. Now, if you do follow along, though, on the InvestSMART website or the Intelligent Investor website, you will see the guys doing videos and writing articles about positions that are in the fund. I know Alex did one not too long ago with Gaurav about Afterpay Touch, which was a holding in the fund which is not held anymore in there. But so if you are checking the InvestSMART website on a regular basis, you'll be able to capture plenty of information about the fund. Let me see. Platinum Management are listing some of their funds on the ASX. What are your thoughts on this? I guess I have no strong thoughts one way or the other. They're absolutely 100% entitled to do that. They're a fund manager, and I haven't looked into it whether or not they're doing a listed investment trust or just exchange quoted managed funds. The difference between the two, listed investment trusts, closed-ended funds. So you raise that capital once, just like Magellan that we just did with raising $1.5 billion. They raised that money, and now that they've got it, it's not going anywhere unless, of course, they pay it back to you as dividends. Or distributions, I should say. The Platinum Fund, I'm not sure. I haven't looked into them closely enough to see if they're a listed investment trust or if they are just an exchange-quoted managed fund. Exchange-quoted managed fund is open-ended, so think of it like an ETF. Cash can go in and cash can go out, and we're buying and selling units as part of that process. So unfortunately, I can't comment specifically on the funds that they're listing. But I just have a look at the type of fund that they're listing, have a look at the fees, and if you agree with it, if you follow them along in the past and you agree with their investment philosophy and investment style. They've been around for a very long time, so they've got a long track record for you to check out. So go and have a look at it year by year, instead of maybe standing back and looking at a 10-year kind of number. Look at it year by year and let's see the consistency of the numbers. That's something that I'd be doing. And then, of course, looking to see if you agree with the fee structure and if it's a trust or if it is a exchange quoted managed fund. So I hope that helps you out. Tom, oh, thank you, Tom. One of my fans here. Tom says, nice to see the new moustache. Will InvestSMART be introducing any new managed funds in the future? Tom, that's yet to be disclosed. We're always thinking of things that will help our members with their investing, and if we can think of something that'll either plug a gap where they don't have exposure but they really should, or something that we think is unique and is going to add value, then yes, we will bring something up. But at the present time, we don't have any specific. We haven't disclosed anything further. Can you, Pete says, can you clarify the tax efficiency of SMAs? Is it purely related to realised CGT? So yes, Pete, realised CGT, and also though the income that you've received as well. So you're receiving dividends, of course, from these companies. So you've got to take that into account as well, and dividend and franking. Comment said, it is said that managed funds management expenses are too high, generally speaking. What is your view? What is our view on funds and their fees? Well, yes, we do think the managed funds fees typically tend to be quite high. Historically, they've been very high. Historically, the 2% management fee and the 20% performance fee, I think not too many fund managers are going to get away with that for too much longer. You see a lot of new funds listing that are cutting their fees dramatically. So yes, I do believe that there will be not a race to the bottom when it comes to fees, but I think they'll be bringing those down quite considerably. But I mean, I do think though, say we charge 97 basis points for a well-managed fund. For managing your hard-earned capital, 97 basis points, I do believe is fair, considering the costs that go into running it and the potential performance as well, and the potential benefit the individual as an investor can gain from that expert management. If our investment team are able to put together and put on the runs on the board what they have done historically going forward, then 1% is a small price to pay for. I think they've been averaging around 11 to 12% in the Intelligent Investor equity growth and income portfolios. So I myself am happy to pay that fee for performance. But of course, you can never guarantee performance. So you need to be comfortable with the investment structure. You need to be comfortable with the investment manager, and you need to be comfortable with the fee structure that you're paying. So I believe that's all the questions that we have there. So thank you for joining us again, and we will be back in the not too distant future with another live webcast. In the meantime, if you have any further questions, you can email me m.sneddon, that's SNEDDON, @investsmart.com.au. Thank you.